Hi everyone and welcome back. Today I'm joined by Daniel Chu from ClearBridge Investments. Daniel is a portfolio manager on the Global Infrastructure Income Strategy and he's responsible for research and coverage in North American gas and electrical infrastructure. Daniel has more than 18 years of investment industry experience and he's been with the ClearBridge team since 2012. Prior to that, he worked with KPMG, advising on infrastructure transactions, as well as ANZ, giving him deep understanding of the infrastructure sector from both an investment and advisory perspective. He holds a Bachelor degree of Commerce from the University of New South Wales and he's also a CFA charter holder. But before we get stuck into our discussion, I'd like to quickly provide a general advice warning. As we go through today's discussion, I'll be discussing financial information which will be general in nature, meaning it doesn't take into account your own objectives, financial situations, or needs, so it's not a recommendation. It's important that you consider if what we discuss today is appropriate for you before acting on it. Also, please refer to any product disclosure statement or PDS regarding the financial product for further information. Details of this general advice warning can also be found at the moneysmart.gov.au website.
Hi Dan, thanks for making time to speak with us today. It's been 12 months since we last spoke with ClearBridge, and a lot has happened across global markets, being inflation, interest rates, and infrastructure investing over that period. Can you provide our viewers with an update on ClearBridge and the global infrastructure sector as a whole?
Great. Thanks, Joel, and thanks for having me. And so, look, you know what? A lot has happened over the last 12 months. Obviously, throughout this conversation, we'll be going through a lot of those topics. As it relates to the firm, the strategy itself, nothing much has changed in that regard. Within our strategy and our team, there has been a couple of personnel changes that's probably worth talking about. Nick Langley, who is on our investment committee, he has stepped down to work on other opportunities within the business. He's still part of our infrastructure value strategy, to be clear. And we've been adding Moaz Mohib to our investment committee, who's been an analyst in our team for the past decade. And so that's been an exciting change for us. Another change has been a couple of changes to our analysts. So David Powell, who has been a portfolio manager of our emerging markets strategy, which we subsequently closed down 12 months ago. He's left the team, and we've added an additional analyst called Nick Morgan, and he joined our team just a few months ago. And so certainly looking forward to seeing his contribution to our team, and hopefully delivering some good outcomes for our clients.
Okay.
Great.
So you mentioned the staff changes just then, Dan, but has there been any changes to the investment philosophy or the portfolio positioning in the last 12 months with the recent changes to what's happening globally?
Yeah, listen. I mean, there have been changes to the portfolio as our normal workflow would go, adapting to different market conditions. As it relates to the investment philosophy, there's really been no changes to that. And so, just to remind our clients here what that philosophy is, it's essentially taking an unlisted framework of looking at infrastructure assets to the listed markets. So, the private side, and taking that framework and putting it into the public side. And what that essentially means is we look at underlying assets, we look at the cash flows on each of those assets, and we take a long-term absolute return approach. And so really what that means is the process is designed to be able to withstand changing market conditions. And I mean, we talk about that a lot these days, right? There's so much change, right? But we feel like if you focus on long-term nature of cash flows, we focus on valuations, we focus on the durability of those cash flows, that volatility and those changing market conditions and those mispricings that you see in the market, we're able to have that conviction to exploit those opportunities. So,
Okay.
so no change to the philosophy, but that's sort of in a nutshell what our philosophy actually is.
So you mentioned private and public markets there. Can you explain the difference between the two for our viewers?
Sure. So, what our strategy looks at is we are looking at investing in infrastructure assets in the public markets. And so, what that essentially means is any listed company around the world that owns infrastructure, that's our investment universe, and that's what we look to, invest in different companies and build a portfolio for clients. The private side essentially builds portfolios as well for clients, but instead of investing in the listed market, they actually own a direct stake in those assets. Essentially, what that essentially means is those assets are essentially harder to get in and out of. So liquidity is certainly more challenging versus, say, a listed market where we can own buy and sell stock just like everyday investors do. Do in the market, share market. Yeah.
Dan, can you walk us through your current investment process and whether any aspects of this has changed over the last 12 months?
Sure. So similar to the question on the investment philosophy, there's been no changes in the investment process over the past year. In fact, it actually hasn't changed materially since I joined the firm 15 years ago. And that's generally a very good thing. And so just for our listeners and viewers here, just a very quick rundown of what the actual process is, and I'll just quickly break it down to 3 parts. The first part is an investment universe screening. So we talked about listed markets. We have to look through the entire listed space, throughout the world, and we find quality infrastructure companies, and we have a proprietary process to be able to distill those businesses to make sure that we are investing in actual infrastructure companies with those cash flows that I mentioned earlier, those strong, robust cash flows. And so that's core to actually figure out what sort of universe we're looking at. We then run a fundamental process. So each of those businesses, we do a deep dive of the business, understand the regulation behind the businesses, because infrastructure assets are typically regulated, or they have like long-term contracts associated with it. So we need to understand those contracts as well for each of the assets they own. And so with that, we can run valuation analysis. We can understand maybe why the business is offering good value and build a thesis around that. And ultimately, that requires a lot of work, and we have a big team to be able to do that work. And then lastly, we have a portfolio construction process, which is essentially those opportunities, that opportunity set that has been guided by our valuation work and the conviction around our investment thesis that gets brought up to the investment committee. So a group of portfolio managers, I'm one of them, who sits on that committee. We then triangulate views to make decisions on what we add or take out of the portfolio. And so there's sort of the 3 main layers to it. There are what we call like macro and risk management overlays we embed in the process as well, to making sure that we're delivering the right objectives and outcomes for clients.
So within that process, and you mentioned risk management, how do you then assess that in the current market at the moment? Because the market's constantly changing.
Yeah, look, it's a great question, Joel. And I think we can all say in the last number of years, the whipsawing action we've seen, heightened political risk, there's just a lot more perceived risk, I think we can describe in today's market environment. And so you mentioned about how do we assess it and how do we look at that? And so, for the most part, right, the assessment typically boils down to how the risks impact cash flows, right? Because there's so many headlines. There's so many moving parts, right? And so it's important to be focused, right? And we focus on, every single political event or policy change or some big macro event. We boil it down to what does it do to cash flows, and so we run that through our valuation analysis. We best represent that through what we call scenario analysis. So we have a base case on what we think the business is worth, but we can run multiple different analysis and scenario analysis to work out, okay, if this event happens, what does this do to the business? In another event, how does it change the business in terms of our valuation? And so that's probably the most important tool that we use to really assess that risk. The good thing, I think, is, and what's comforting for investors is, a lot of these, large macro events that you see in the news and all of that, when you actually run that impact analysis to cash flows, we notice it's typically little impact to fundamentals of infrastructure companies. And so if I boil that to, like, say, another important risk, which is important to highlight, is inflation, because that's been a problem over the last number of years. And we know it's on investors' minds, it's popping up again. And it's important to understand inflationary impacts as a key risk. And we understand that is an important risk. For our strategy, again, comes down to cash flows impacts, and that means understanding contracts and regulation. So what's important for investors when you look at infrastructure is infrastructure has inflation pass-through mechanisms inside the regulation and the contracts, which is really important because that pass-through essentially protects your fundamental value, right? Because it means there's no impact. Inflation goes up, you can pass that through to your cash flows, and protects your value. And so 90% of our portfolio is able to do that, pass through that inflation, either directly or indirectly. And so it's a really important risk, and we think investors can take a lot of comfort that long-term valuation is not impacted by inflation or rates in general.
Okay, so we spoke about inflation risks, but looking ahead, what do you see as the most compelling opportunities in global infrastructure, and what are the other risks opposed to, say, the inflation that we just discussed?
Yeah, another great question. And I think if we were to look at the last, 18 to 24 months, maybe a bit longer than that, everyone's been focused on AI, and the opportunities related to AI. We're very fortunate that infrastructure also benefits from AI, and there's a lot of opportunities in the infrastructure space relating to it. And if I were to sort of narrow it down to certain pockets of businesses within infrastructure that are able to grow and benefit from AI related demand, it's power generation, it's electricity grid expansions, and gas infrastructure expansions. And so so the opportunity really is that there's a need for power to power the AI, all these models. Infrastructure is at the heart of that, and we feel like that growth is still underestimated and will prove to be a multi-year theme. Now, if we were to talk about the risks component to it, where there's opportunities and where there's growth premiums embedded, because obviously, the performance for some of these companies have been very good, and we can see that in other pockets of AI exposure in the markets. The risk is that we have to be careful when pricing this growth opportunity, because there are premiums embedded in it. A lot of it's justified, but what investors have to do is you have to do the work to actually understand the value that's added to these businesses. You have to understand execution, right? Whether or not they can actually do it, because people are expecting these companies now to execute on growth ambitions. And so if companies are able to actually deliver that, then premiums are justified and they're compelling opportunities. If you incorrectly assess that, because there's some companies that will maybe be AI hyped, or people perceive them to be benefiting from AI, and if that doesn't happen, then that's where there's pockets of risks which investors could be overlooking, which is why even though they maybe have those strong themes, you still have to do the homework to actually really understand how they benefit and if they can execute.
Okay, so expanding on that, infrastructure's traditionally being viewed as a defensive asset class. And when we consider it as a defensive asset, how's it actually performed in the current market environment? And what are the lessons that we've learned over the last 12 months?
Yeah, it's actually a great question, because it kind of links to some of the points that we've mentioned before, right? So, last 12 months have been pretty strong. The strategy returning over 20%. And to be fair, the overall market's done quite well also. And so obviously, I think that's probably surprising for investors, given how volatile the environment has been, right? And you can find pockets of time in the market where you have those periods where there's a lot of macro risks brewing everywhere, and large changes, and yet the markets continue to make that move up. And so, there's some lessons to learn from that. And, I think investors always need to remember that ultimately these companies are businesses and influenced by fundamentals. And so this is what we do, right? This is what we do. We're fundamental investors. We have to understand the ultimate impact of these businesses. And so if you can sometimes distill some of the noise that you see in the markets, and in news and all of that, and you focus on those fundamentals, when you can build that conviction, it keeps you invested in these companies and actually takes advantage of opportunities. And so that's how you can deliver some great outcomes, when you can sort of narrow your focus and focus on those fundamentals. Because in the infrastructure space, and we touched on some of the opportunities, those fundamentals have improved meaningfully. And so if you were to identify that, then actually volatility are actually opportunities to buy, right? And to benefit from.
So we spoke about the AI sector and the supporting industries that are building out that infrastructure, but are there any other sectors or regions or themes within infrastructure that you're particularly excited about right now?
I might drill down a bit more into actually some of the AI opportunities,
Sure.
because they're all different in many ways. And so there's lots of different pockets where we can benefit, and we're still really excited about some of these opportunities. One of them that's been more apparent this year is what we call behind the meter generation. And essentially, to build power, to build capacity, it takes a long time to do it, right? You need to go through permitting, lots of gates to of stakeholders to get through,
Red tape.
and it's all the red tape, and it's proving to be more and more difficult, right, to build these plants. But hyperscalers need capacity now, right? They need capacity now. And so what behind the meter generation is essentially build your own next to your data center, bypass the grid, which you have to go through all that red tape, and you then can have that power to your access to then build your data centers, and continue the AI build out. Now, a lot of the infrastructure companies, Williams and Pembina are pipeline companies that we own that are at the forefront of providing that behind the meter power service to clients. This is becoming much more prevalent now because of continued pushback especially from local communities on building capacity. It's growing in the US, and so these solutions are innovative, and we've got some companies that actually really are at the forefront and benefiting from that.
Okay. So we've spoken about AI a lot at the moment. Uh, is there a specific example of an investment that's performed particularly well over the last 12 months, other than AI, or also in conjunction with AI? And what are the key drivers behind that success?
Sure. Well, we'll go through a US utility as an example. And so Entergy is one of our top holdings in our portfolio. It's a US based regulated utility. It serves multiple states around the Gulf of the US. So think Louisiana, Mississippi, those areas. And they've benefited from a number of things, right? So AI is one of them. And we'll talk about it in a sec. But also, our thesis that we've had for this company over a number of years has been actually de-risking. De-risking on a regulatory side as regulations has improved in the state. They've had some litigation that they've had also with some stakeholders, which have settled. There was risk around that, and they've sort of settled that. They've improved the relationships with their regulators. They've turned more constructive. And now they've also been able to increase capacity relating to AI through lots of data center deals, for example, with Meta building capacity down in that Gulf Coast. So this is one of the stocks that's done particularly well. Multiple drivers of that, and AI is one of them. As a result, this company is seeing growth of their earnings in the mid-teens for the next 5 years. You think about for a utility, for a defensive utility, that's a fantastic growth rate.
Conversely, were there any investments or market events that challenged the portfolio, and what did ClearBridge learn from that experience?
Yeah, I think the challenge for us this year in some of our investments has been probably more idiosyncratic, to be fair. And so when the most important thing that we always learn from is, despite these strong themes that we talk about and all these growth drivers, you still need to monitor and evaluate things like regulatory risk, all the stakeholders that these companies deal with, because it can turn against you. I talked about Entergy just before, how that turned positive. Now, we've had an example recently where it actually turned negative on a company. And so the example I can offer clients is this company called Rodea, which is a Spanish transmission utility. Now, we were expecting a great regulatory outcome, right? So we're going through a regulatory review where they open up everything and they then set the new framework for the next 5 years. So it can either be a great positive thing or it can be a negative thing. And so we were hoping it would be positive, but it actually turned out not very constructive. And that was due to a blackout that they experienced a number of months prior to that, which then they got a lot of political flack for, and then that fed into the regulatory outcome. And so didn't turn out great. And so we did have to exit that investment because of that. And so not a great outcome for the electricity sector, but Joel, hey, they are great at football.
How do you stay ahead of the emerging trends and developments that may impact global infrastructure?
Yeah, no, it's a great question, and the answer is that we have to engage companies consistently. It's one of the benefits of being in a large team, and it enables you to be closer to what's happening on the ground, because we can talk to the companies. They can start communicating things that are slowly changing the business. And so when you're close to that, you can pick that up. And so the behind the meter stuff I was talking about is an example of that, where you didn't really know how big this opportunity was. People really talk about it a lot, but a couple of years ago, you start to get snippets of it, and as you engage with management more, you pick that up. So that's typically the best ways to actually capture those emerging trends.
Okay. Now, Dan, what characteristics do you believe are the most important for a successful portfolio manager in today's investment world?
Yeah, especially in today's investment world, lots of changes, very volatile, right? I just think the ability to just balance your adaptability and your willingness to stick to your convictions is really important. And the key word's balance, really, because things do change, and they do change a lot. And so you need to also know when to change your mind with new information and incorporate it properly in your investment analysis, right? And sometimes you have to admit that you're wrong, right? Your work can tell you're wrong and act on it. And then conversely, right, to stick to your convictions when your analysis tells you that the impact's minimal and you should be sticking with your position, or you should be adding to it, right? So the ability to balance that out well, especially with how much changes have been going on in the markets, I think is probably one of the most important characteristics that that investors need.
So, Dan, finally, what key message would you like investors to take away about global infrastructure opportunities over the next 12 to 24 months?
Sure. So look, infrastructure remains a really attractive sector. And we model our returns over the next 5 years. We have expectations of returns. We think they're around 12% over the next 5 years, so it's pretty good. We talked about some of those growth drivers that we talked about. We think those growth drivers are still not reflected in market valuations, despite the strong performance that we've seen over the last 12 months. And so as we talked about, markets being increasingly unstable, we think having allocations to defensive asset classes that provide strong cash flow protection, inflation protection, I think is important to have in a portfolio. With the added bonus that our infrastructure strategy also provides strong dividends. Call it 4.5% to 5%. It's growing mid-single digits, provides really good income opportunity as well. And so we just think the combination of all those factors is compelling for investors, and we remain increasingly optimistic in the infrastructure space.
Okay. Well, Dan, I appreciate you making the time to speak with us today.
Great. Thanks for having me, Joel.